In 1986, Congress rewrote the tax code and buried a single provision so deep inside the revision that fewer than 3% of American real estate investors have ever used it correctly. No one on television explained it. No financial advisor brought it up unprompted. By the end of this, you'll understand exactly what they didn't want you calculating on your own. It is called Section 1031, and on paper it looks simple. You sell a property. You reinvest the proceeds into another property of equal or greater value, and you pay zero capital gains tax on the sale. Zero. Legally. The IRS allows it, has allowed it in some form since 1921. The modern framework was locked in during that 1986 overhaul, the same overhaul that eliminated dozens of investor-friendly loopholes and handed billions in new tax exposure to the middle class. The same overhaul that was called the most sweeping reform in 40 years. They closed almost everything. They left this open, and they wrote the rules in a language almost nobody reads. Here is what the exchange actually does. When a normal investor sells a rental property that has gained value, the government takes a cut, typically between 15 and 20% of the gain, sometimes more when depreciation recapture is added. On a property that gained $200,000 in value, that can mean $30,000 to $50,000 leaving your hands before you reinvest a single dollar. A 1031 exchange defers that entire payment indefinitely. You roll the gain forward into the next property and the next and the next, and if you hold until death, your heirs receive the property at its current market value. The deferred tax bill disappears, permanently, not reduced, gone. That is not a loophole. It is the written law, and it has been sitting in plain sight for nearly a century. Now here is where the official story starts to fall apart. The IRS publishes thousands of pages of guidance every year. Retirement accounts get their own dedicated education campaigns, television advertisements, employer onboarding packets. 401k contribution limits are announced on the news. But 1031 exchanges, a mechanism that can eliminate tens of thousands of dollars in tax per transaction, receive almost none of that. The Treasury knows this tool exists. Financial planners are required to be aware of it. So why does the average real estate investor hear about it, if they hear about it at all, only after they have already sold, after the tax bill is already due, after the window has already closed? And here is what makes it impossible to write off as oversight. The 1031 exchange has a 45-day identification window and a 180-day closing window. Those deadlines are hard. Miss either one and the entire deferral collapses, and you owe every dollar you thought you had protected. Now watch what happens next. The investors who use it consistently are not ordinary buyers. According to a 2021 report from the National Association of Realtors, 1031 exchanges accounted for 10 to 20% of all commercial real estate transactions by value in certain markets. That means the tool is being used heavily, but by a specific class of investor. Institutional buyers, repeat players, people with attorneys who specialize in exactly this provision. The mechanism was written to be technically available to everyone and practically accessible to almost no one. In 1986, the same year they simplified the code, they made the process just complicated enough to require a specialist. A qualified intermediary, a third-party escrow holder, must handle the proceeds. You cannot touch the money yourself. Any direct receipt, even for a single day, kills the exchange entirely. That rule was not an accident. That rule is the gate. And here is the thing about that gate: nobody sent you the address. Think about who sits on the other side. Qualified intermediaries are an industry, a lightly regulated, largely private industry. And the investors who know to hire them, who know the 45-day clock starts the moment escrow closes, are the same investors who have compounded wealth through this provision for decades without interruption. A mid-century investor who exchanged through 10 properties could have deferred millions in capital gains, passed the portfolio to their children, and watched the entire deferred tax balance vanish at the step-up in basis. The wealth transferred. The bill never arrived. and the ordinary investor who sold their rental that same year paid the full amount, reinvested what remained, and restarted the compounding clock from a lower base. Same law, different outcome. Because one person knew the gate existed and the other was never told there was one. Legislators have proposed eliminating the 1031 exchange in 3 separate budget cycles since 2021. None of those proposals passed. The provision is still active, still available, still buried where it has always been. So here is the question that does not have a clean answer. If a provision this powerful has survived nearly a century in plain view, used heavily by the few, missed entirely by the many, what else is written in that same code, in that same language, sitting behind a gate that no one thought to mention to you?